Alright, this is the teaching on chapter 2, and this one is going to be on imbalances. Now, imbalances, some of you guys have become familiar with the term imbalance because I refer to it a lot within the chart analysis that I send to you guys, and I also touch on it quite a lot within the midweek commentaries. What is an imbalance? An imbalance is when there is not sell side price delivery matched with buy side price delivery, and vice versa at every single price level that we see. Yeah, so all these price levels, so all your price here, we want to see an equal opportunity of buying and selling at every single price level, right? So when we see a candle on any time frame, right? I'm using the daily here for an example. When we see one candle move upwards very quickly and it doesn't leave any downside, that causes an imbalance in price. It's one-sided price action. And now that has to be rebalanced. The algorithm has to rebalance areas of imbalance. It has to offer a fair trading opportunity of buying and selling at every single price. This is why we have liquid markets, right? Every single time you go long, someone has to be short. Every single time you're short, someone has to go long. Otherwise, you won't be able to go long or short at those positions. How can you buy the dollar, right? If you're buying the dollar on this DXY chart, let's look at this candle. Look at the candle's open, right? The candle's open is here at 93.983. Now, if you're buying the dollar at 93.983, but no one is willing to sell the dollar at 93.983, well, guess what? You can't buy the dollar. It doesn't work like that, right? There has to be fair trading at every single price, right? So what do we see happens when we see a candle move one way very quickly? We have to see that candle get rebalanced. We have to see that price action that moved heavily in one direction but get rebalanced. Now, I want to take your attention to this candle. Yeah, this candle right here. When we saw this candle trade, what happened? It moved up quickly one way. We would then expect, let me just move this here. We would then expect the next candle, so this one, to wick within it, right? Because you see how these candles all trade, right? This candle moved up higher, this candle wicked down, this candle then left an imbalance here, and then these wick down into it and then moved up again, wick down into it. All of this got traded into, but there was no trading back within this buying. There was no selling to pair this buying. We need to pair this buying with selling. They need to trade back into this area to rebalance that price action, to make it efficient price action. Right now, this is inefficient, and the market will always rebalance these areas, right? And one thing I love to trade off of is imbalances. For me, that's one of my go-tos. I tend to favor them over order blocks as well. Of course, when they match up with the order block, it's a lot better, right? So, what do we see happens when we trade higher? When we see this level happen here and we see this consolidation and we start to see it come down, well, where do we expect it to come down to? This is where people, they don't understand price action. They don't understand where it's going to go. They think that this probably is the end of the trend. But what do we see? We see this area, this candle, right? It needs to be rebalanced, right? It needs to be rebalanced. This candle needs to be rebalanced. So what happens? Now, this candle, the entire candle does not need to be rebalanced. For your notes, I want you guys to do something. Whenever you see an imbalance, just one big candle, right? take out your fib tool, measure the high to the low of the imbalance, the 50 level, you want to mark that out. The 50 level you want to mark out, however, it doesn't need to always trade to the 50. It's like any other block, mitigation block, breaker block, order block. It can trade, it just trades within it. It can just tap it and then move away, but it can trade within it. This is where you monitor. When you see it come into here, you want to see the monitor, you want to see the rejection. And we see the rejection here. When we reject off here and then this next candle, we see the displacement away from it. It's kind of a telltale sign that we've rebalanced this area. We haven't rebalanced the entire area, but this candle to an extent has been rebalanced. You don't always need to rebalance the entire area. Yes, it can rebalance the entire area. However, we are always just assuming an rebalance of the area within the candle. It doesn't have to be the entire candle, just within the candle. And this is where monitoring it helps. So let's look at something that happened today, right? Let's look at today's price action. This is today's price action, right? So look at today, right? Yesterday we had one move up. We had one move up. It just traded up in one way. And what did it leave? It left an imbalance, right? It left an imbalance because this candle only traded up one way. So from this candle's high, yeah, the close of the body to this candle's wick, from this candle's wick to this candle's close, because the candle, why doesn't it, you might be asking, well, why isn't it from the high of the wick? Why doesn't the imbalance start there? Because what does the candle show? Let's go back to the anatomy of a candle. What is a wick? The wick just shows that price went there and then it came down and it closed here. And that coming down is selling. So in that area of the wick, the high of the wick to the close, there was actually selling in there. So we don't need to rebalance that because I was selling in that area. However, within the body, there was only one-sided price action. And then what happened today? Today, we traded, made the low of the day within that candle's imbalance, and we traded higher. And what do we see today? The same thing happened. We now traded higher. So we want to see, if I just move this, now this is a new area of imbalance that needs to be rebalanced. And now, what is this candle that I show you guys as well? Let's put that down a bit. This is the breaker block, right? Low, high, low, high, lower low, higher high, last up close candle. We bring that out in time and we get this area, this candle, this entire candle will bring out into time. And now what do we have? Well, we have the imbalance area matching with the breaker block, like an added confluence type thing, right? These last two down close candles together are also an order block, right? So you want to monitor the trading within this imbalance because we assume there will be some level of retracement within this imbalance. Now, if you go to a 4 hour, again, you can see is only one-sided trading, right? Again, if I bring out this candle, This is your bullish breaker in line with the imbalance. And you see how it's with the 50% within the 50%, right? So let's measure the imbalance because this was the imbalance that we had. That's a bit dodgy. Let me delete that. If this doesn't prove to you that the market is algorithmic and that these things, all these breakers, imbalances, they all are in conjunction together, they work in line together, there's nothing else I can prove to you because the midway of the imbalance, which is called consequent encroachment, and we label that as CE, right? So this, we'll just call this CE, consequent encroachment, right? Call it CE for short. This lines up with the breaker block here, 50% of it. So if we remove this, this consequent encroachment is also equal to the opening of the breaker block. So you want to monitor this price level tomorrow. You really want to see price move lower into here, reaccumulate for move higher. There's also the fair value gap from here to here. However, we don't want to consider that. You always want to consider the most recent one, unless there is bearishness. If we break down lower in this, if we disrespect this imbalance, so we trade lower into like this wick, then you start to look to trade into here. But for the time being, you look to trade within here. Your eyes doesn't just go right here. You don't do that. You anticipate what is in front of price first. Because I know guys are saying, but what about this imbalance here? What about there's this imbalance here? What about this imbalance here? There's no imbalance here. But look at where price is right now. Why are you looking down here? Why are you looking down here? Look and deal with what has price got to go through first. If we disrespect this one, then fine. It's likely we'll trade to that one. And then you can be short on the dollar to here and long on Euro USD because it will match up with Euro USD. They're just inverse pairs, right? So look here. If we go on the daily, what do we have? We have the imbalance, right? So if you want, you can pause the video here and label the imbalance of this candle, right? So if you did pause it, the imbalance is from here to here. GBP USD has a smaller fair value gap imbalance from this wick, right? Because why this wick? Why this wick? Because price went down here. When price went down here, it created the low here and then it bought back up here. So there was buying within this price action and there was selling here. So at this price from the wick here, there was buying and selling. Understand? Because the way you make a wick is price went there and then it went back up. So at the end of it, there was buying. Then this candle, there was selling. Up until this point, up until the end of this wick, there was both buying and selling. Efficient price action. However, you know the space in between the wick, there was only what happening? Only selling happening. So we want to see it close the space between the two wicks and offer buy side price action trading in that space. That's all an imbalance is, right? It's wick to wick, yeah, right? Okay, so for example here, this candle traded down, this candle left an imbalance. The imbalance starts from the previous candle's low, right? So here and here. You saw how we just dip into the imbalance and we trade lower. This is probably the draw on liquidity, by the way, on this low. And for the Euro USD, you guys know how long I have looked at this low to take out, right? And ultimately, uh, want to take out these lows. But if you see how price rebalances in this area, just if you're awake when price is trading, right? I don't want you guys to actively trade right now because I feel like you'll be very hit and miss with your trading because there's no way you guys have a trading plan at this moment of time because we haven't even covered half the content. We haven't even gone intraday yet. So it's very unlikely that you have a model. I want you guys to see how areas of imbalance get rebalanced, right? So this is a daily. If we go onto the 15-minute, let's look for areas to get rebalanced. One area I was looking at actually, I remember, was this one. This was the high of the day for today. So before we opened up today, right? Today was the 5th of April, right? So 5th of April, on the 4th of April, I mean, we had here to here. And what the price do today? We dipped around the 50% of that imbalance and we traded down below. Now, if we disrespected this imbalance, then we start to consider these ones. Is where you start to see the rejection, right? This is where intuition and logical framework comes into the picture, into the equation. But what do you also have here? These last two down close candles make your bearish breaker. So you have the breaker and you have the imbalance. Line it up together and it makes sense for price to trade it because algorithmically, think about it. You have two price arrays. You have an imbalance and these rebalancing, which is very, very, very significant. And then you have the breaker. So does it make more sense to trade here or to reject here? This is more resistant to the algorithm. Is more resistant in the sense that there is greater opportunity, greater willingness to reject at this area because of the imbalance plus the breaker. Now, one thing that I wanted to show you guys, and this, right, this you guys will never have heard about. And this is the stuff that, your SMC gurus, they have no clue about because they don't understand algorithmically how price delivers. Let's consider this candle. Yeah, I wanted to focus on this candle. Yeah, these three candles. This one, and this one. You see this candle, right? How it overshot this imbalance here. And it went all the way up into this imbalance. Although it didn't go anywhere into it significantly, look at this candle's wick compared to this one. It's higher. It traded just into that imbalance and it's swept that high. Now, why didn't this candle respect that imbalance? Well, because this candle didn't have an imbalance. Let's go on the replay button. Let's replay it from here. So there's an imbalance now, right? From this candle, from this wick to this close, if that is a close, right? Now, what happened? Now there's going to be imbalance from here to here. But the next candle, let's see what happens. Now look, you see this candle, the wick of it, yeah, when it creates this long wick. If the next candle, right, this is called redelivered rebalance. If the next candle trades lower, right, it trades lower than this wick. When there's a wick here and then the candle trades lower than the wick, ignore this candle. Ignore this candle. The middle candle, ignore it. The imbalance you're looking at is from here to here. You're not looking at this imbalance from here. You're not looking at that. You're looking from here to here. This candle's imbalance, disregard that. Disregard it. Why? Because there's buying in here. Don't look at the candles. Look at the logic between what an imbalance area is, guys. What is it? An imbalance is when there is one-sided price action. Now here, what is there? There's already buying and selling here, right? This candle, when it's aggressively with the wicks, when it's very wicky, don't consider this middle candle. When you got this candle, it's like a little formation, right? And it's the same pattern every single time. And the opposite is true for bullish scenario. When you have one candle trade down, and then the next candle trades lower with the wick, and then this candle wicks above it, goes lower, and then wicks it, disregard this candle. I'm going to try find another example for this because this is not the best example. I've seen better examples in, past price action in the past. I'll try look for some, but for now, disregard these type of imbalances. When you see here to here with the wick, you want to look at candles with nice, where the low is close to the close and where the high is close to the open, if that makes sense, right? So essentially where there's smaller wicks. When there's bigger wicks, one after the other, the second one, cut it out. Just cut it out. Go to the first imbalance here. Just leave this one. Now, how do we use imbalances? Well, of course, right? It's the same as anything else. When we look at the imbalance on the higher time frame, we don't trade off the higher time frame. We use these imbalances on a higher time frame as areas where we expect the reaction to occur. This is where we expect, the retracement to end before a continuation or expansion again to the upside for the DXY. And then on your lower time frames, right? Um, I'm sure I traded off a few today. Five, 5th of April. All right, cool. Here. This was in the live video. I was looking at this imbalance here and this imbalance here, right? You see how there's a little volume imbalance here as well, which is nice. We like to see that with imbalances. But if you see the live video I posted today of the Uncut London session, right? You'll see that I put like I've done something like this. You'll see that I've done something like this because this is where I wanted to get out the trade because price could fill this imbalance and then it could, take off. Now, if you go to the 1 hour, I think it's cleaner, right? So if you go to the 1 hour chart, you have this imbalance and you see how the bodies, right? Of course, the wicks go through it. Understand that. Look at the bodies of the candles. Look at the bodies of the candles, right? Because the bodies of the candles is where the bulk of the orders are, right? These wicks are subject to your broker manipulation, your broker feed, etc. It's dependent on your liquidity pool that you're in within your broker, and I'll speak about that very in depth when we touch on intraday teachings and we touch on market maker theory, because there is manipulation that goes on within the wicks, right? But look at the bodies of the candle. This body is the lowest body, and compare it to where the imbalance is. It doesn't overshoot it by much. You have this imbalance here, and it's paired with an order block here. What I want you guys to stop piecing things like this together. Piece two of them together. So you have your imbalance, and in the start of this video, I was piecing the imbalance with the breaker block on the DXY. On the Euro USD, there was the imbalance with the breaker block again. This one, we have order block and imbalance. You want to pair those things together all the time, right? Now you see like another example here. We're moving up in one way. You see, look at this. This is called institutional order flow. When there's an up candle and there's imbalance, and then the next candle comes, rebalances it, and then it moves higher, it is a good indication that it is going to be buy side delivery. Why? Because the algorithm is rebalancing as it's going, rebalances as it's going. If it had intentions, yeah, if it had intentions to go back down, it would leave the imbalance there to come back later on its way down to grab any sell side liquidity existing within the market and rebalance that area. As you see, it rebalances the area and it keeps moving higher. And then this candle wick comes down lower. It doesn't have to rebalance the entire thing, but as you see, the candle goes lower, rebalances it and moves higher. It's bullish indication that is going to be a delivery on buy side liquidity. And today there was the buy side delivery on these highs. I think the high to the left of it as well. But that's all there is for imbalance. The imbalance is just when there is an inefficient delivery or price action, when it's one way, either to the buy side or the sell side, leaving large candles in one way. The body of the candles from the previous candle's high or low to the candle with a large imbalance close is how you define the imbalance. On the higher time frames like the daily one and the 4 hours, the weekly, monthly, etc., those are where you just expect retracements to end. You want to see those areas become rebalanced, and then you monitor it to see if there's going to be like a willing expansion higher, for example. So tomorrow for the DXY, if you're watching this video when I put it out, you want to watch this level, right? 99, 280, 278. You want to see if we're going to retrace into this imbalance before moving up higher. If you've got any questions, hit me on Snapchat, Telegram, or Discord as well. Look for examples with imbalances. If you're still unsure, the only way you lot are going to learn, go on the chart and find an example of imbalance. Screenshot it, show it to me, and I'll confirm if it is or if it isn't. And if you were wrong, I'll tell you why it was wrong. That's the best way you can learn. There's a lot of people that do that already, and those people seem to learn the best as well. So the next lesson for next week, I'm going to try to do 2 lessons, right? Because I want to try and get chapter 2 finished soon, because there's a lot of content in chapter 2. But I'm going to update you guys if I will be doing the 2 lessons, because I think some guys are still catching up. But that's all for this lesson. Any questions, ask me on the Discord or Snapchat, and that's all.